Welcome back, investors. Today we are talking Uber. I put out a Twitter poll the other day about whether to do Square or Block, the payment processor, to do PayPal, also a payment processor, or Uber. And it seemed like my Twitter audience was interested in Uber. I've heard a lot of buzz around their stock recently, and so I thought it was a good place to start. Something I don't usually do when I introduce is give a little bit of an outline of what we're going to cover. So I want to do that real quick, just so if you're tuning in for the first time or you want to be able to see something specific, you know where to kind of skip to. So this overview is going to show a lot of the quantitative factors. So looking at the numbers, we're going to go through, and I look at three main things when I'm looking at the quantitative factors of a company. I like to look at working capital, where the money's coming from, how they're generating cash. I like to look at capitalization, how they're funding the business, how they're using debt, and then profitability. What are the long-term prospects of the company? How is it performing? And then I go into the qualitative factors, looking at things that will affect the competitive advantage of the company, its ability to compete with competitors, and also listing out competitors here near the bottom. So I'm going to try to scroll back up here without my little bottom bar coming back up. Okay, here we are. So looking at current price, I haven't checked it today, but yesterday it was at 44.45, which is when I started compiling this all. And then price history, we can see that from 2019 to end of 2022, it decreased by almost 6%. But of course, we're up to $45 right now, with a high of $60 back in 21. So price is performing all right. It fluctuates. It's not a super stable company yet. Something to note here with Uber is that they didn't actually become a publicly listed company or do their IPO until May 10th of 2019. So, I got some information here for 2018 from Seeking Alpha. I'm not sure if that's out of some of their filings in order to go public, but take that fifth year with a grain of salt. 2019 to 2022 is probably going to be your most accurate numbers. I like to look at the ISS governance report. This just tells you kind of how ethical the company is working. And so they usually do an average score, but they look at 4 factors: audit, board, shareholder rights, and compensation. 1 is the best, 10 is the worst. And they actually have really good scores here: 2, 3, 2, 6 for compensation. That's usually one that most companies have a higher number on. But the fact that they're staying 6 and below is great. Their profit margin, operating margin, return on assets, and return on equity are all not looking great. This, of course, is a current number here in June of 2023. And with that, just note, most of my information goes to December of 2022. So as we're looking at this in June of 2023, some of this information may be a little different now. There are certain considerations you definitely want to think on. Maybe look at the quarterly reports. I focus on the annual report, the 10K, when I'm looking at a company. And for that reason, we may be a little delayed. When I do Nike here in a week or so, that will actually have the most recent annual report so far that I've looked at. That will be coming out, I believe, in the next couple days. They'll actually be publishing that. So as soon as that's out, I'm going to read through it and get you guys a video on Nike. But moving forward here with Uber, their cash flows are actually really good. 1.23 billion in operating, 754 million in levered free cash flow. So bringing in money, able to run the business, able to pay down debt, hopefully. Their price earnings, their trailing 12 months has an NA, and that's because it's been negative for the most part. I pull this single column stuff from Yahoo Finance, and then when we look at 5-year history, that's out of Seeking Alpha. I have some other platforms I'll often get information from, like my Fidelity brokerage. It has really good stock screening and research tools, but for most of this, it's Yahoo Finance, it's Seeking Alpha, and then it's the 10K annual report, because again, I want to get that information from the horse's mouth. So looking forward, price earnings at around 100. that makes sense since they're earning only maybe a dollar or a couple dollars per share, and they're running around $40. So that definitely checks out. Price per book's 11.68, not great, but Uber, their name is Uber Technologies. So they see themselves as a technology company, not necessarily as like a vehicle or taxi company. And for that reason, their price to book's gonna be higher, like most tech companies are. Their price per sale's not bad, 2.55. So you're definitely not really way overpaying for what you're getting out of it. But as we see some more numbers here, I think, that'll be tempered a little bit. So as far as their dividends, obviously they don't pay a dividend. They're a newer company. They're not, financially viable at this point to pay dividends. And I'll talk a little bit more about that here in our final section. Has, a little bit of insider ownership, not a ton, but I like to see at least some. As far as current ratio, it's actually decreased over the last 5 years. Went from about 2 down to about 1. That just has to do with the fact that they're probably not keeping as much cash on hand. They're having to finance things, and so that's going to affect their current ratio. Really, you want to see this going up. So I've tried to do a little color coordinating here, red, greens, and oranges. So hopefully, it doesn't look too much like Christmas or anything wacky here. But so that kind of gets a red from me. A little bit of red flag, seeing a decreasing current ratio. That just, doesn't sit great, especially at negative 12%. But we'll keep looking into some of these numbers, right? So cash generating power ratio. With Uber not having, necessarily inventory on hand, so you can't do turnover ratios or anything like that, I wanted to kind of look at something new. Any set of ratios you use is going to give you a different picture of the company. I decided to do a little dabbling in some cash flow statement ratios recently. And so cash generating power, let me pull over here. I did a little note for us, and hopefully you can see it. Cash generating power ratio, it tests the company's ability to generate cash purely from operations compared to total cash inflow. So the formula is cash from operations divided by that same number plus cash from investing inflows plus cash from financing inflows. And so on the financial statement, your cash from operations, that's typically your net cash from operating activities. Investing inflow is typically investment changes net plus sale of PPE plus other investment activities. And then your financing inflows typically involve long-term debt proceeds plus issuance of equity. So that to say, it's a little bit different of a ratio, and just gives a kind of a different picture about their ability out of the actual operation of the company. How well can they actually generate money to, pay to continue to operate, or pay to, pay their interest on their debt, if not their principal. So as you can see, it really was kind of not great for a while, but kind of going up to only negative 12 and 21, and then up to 67% in 22. So definitely strong improvement there in their ability through the operation of the company to bring in more money. On this compounded annual growth rate, CAGR column, there in column J, a lot of those are grayed out if the number at the beginning is either negative or if it's a 0. Compounded annual growth rate does not work very well if you have negative values in there, but it is the most accurate way of averaging a return for investment activity. So as far as capitalization, so cash is looking okay. Again, current ratio is pretty low. Kind of a red flag here in debt to equity. An increase of 12.5% basically over the last 5 years, going from 76% to 137%. That's not a good sign, personally. But again, we're in kind of a growth stage for this business. So, a big thing they talk about quite a bit in their annual report is the need to, continue to finance, continue to have credit. And so if they have difficulties with that, obviously it's going to be difficult to continue the business. So until their revenues are truly stable and they're able to continue to reduce those expenses, they're going to have to keep taking in debt compared to the amount of equity shareholders actually have. Typically, if you see debt to equity going up, you also see the current ratio going up. So I'm interested in where some of that cash is having to go to. As far as debt to assets, these top three, debt to equity, debt to assets, assets to equity, they really show similar pictures. You're dealing with, assets equals liabilities plus equity. So you would think they would all look the same, but, your debt does not include all liabilities, right? Debt typically doesn't include all your current and necessarily all of your long-term liabilities. So it's going to change the picture there. So like when you're comparing assets to equity, you're taking assets and then you're taking out all liabilities, not just debt. And so the numbers are going to look quite a bit different there. So in terms of debt to assets, that is also increasing. Not something you really want to see, but it's only increased by 3% over 5 years. So it's remaining fairly stable. It's interesting because it'll be about 30%. It'll drop into the 20s, be about 30, drop barely under 30, jump back up to 36. So it fluctuates. I'm not terribly concerned about that. As far as assets to equity, again, you're taking out all of your liabilities here to compare how much shareholders actually have in equity to the total assets on the book. So of course you want to see a lower number here. So also it's increased over time. So you have more assets on the books in comparison to the amount of equity. Ideally, the more assets on the book, the more equity you have available to investors. It's telling you how well they're utilizing that to create retained earnings for investors in the company. Especially for a company that doesn't pay dividends, you want to see them have more and more cash to invest back in the business. So if that asset to equity level is going up, that's not necessarily occurring. In terms of tangible book value per share, again, they see themselves as a tech company, so this number is probably going to be low. It's actually improved a little bit over time. It did go back negative $1.39 in 2022 after it had been positive for 3 years. Went all the way up to 8 in 2019 and has slowly trickled back down. So I think here in 2023, we want to see that tangible book value continue to go up. But again, for a tech company, especially one that engages in acquisitions and divestitures, that tangible book value per share is always going to be tempered because you have a lot of intangibles and you have a lot of goodwill on the books. So moving into profitability, I am trying to move a little quicker here. I know in my past videos, I've hit about that 30-minute mark, and I'm trying to cut down on time because I know you as a viewer, your time's precious to you, and you don't want to sit and listen to someone ramble. So going into profitability, earnings per share also not looking super great. They started to kind of come up in 2021. That probably had to do with the pandemic starting to kind of come to a close. People start moving around a little more. Money's flowing into the business. Going back down in 2022 and probably going to see, some slight decreases here in 2023 as consumers have less cash. I would assume once student loans start, that also puts a strain on discretionary spending for a lot of Americans. So, we'll see what this looks like moving forward, but earnings per share definitely needs to start increasing and at a stable, constant rate. As far as revenues and gross profit, I think this is where a lot of people, when they're looking at Uber, like I said, there's a lot of hype around this company right now. A lot of people are buying in, they're loading up on shares. They see a lot of potential, which I'm not saying I don't see potential. I'm just saying, this I think is where a lot of people look at, right? So revenues, gross profit, these have all increased, and I'm really impressed by the increase to see 25% increase in revenues over 5 years, 18, almost 19% increase in gross profit over 5 years. So they're running the business well. They are doing everything they can on the operating side on their revenues and direct expenses to bring in revenue. However, their operating margin, it's also increasing, but it's hopefully going to continue to do better and get into the black. Obviously, still trailing negative. So hopefully here in December of 23, when we get that new annual report, probably in February of 24, we see some strong positive numbers on their margin. So we move into the out of quantitative, out of the numbers, and we're going to start looking at maybe the more qualitative. A big thing that you want to look at is the competitive advantage of a company. This is a section that I fill out when I'm reading through the annual report, the 10K filing that's on file with the SEC, Securities and Exchange Commission. These are just things that I pick out as I'm scanning through that. So some of these are still quantitative, they're still numbers related, but most of it is just the qualities that make up the company and give it either strengths or weaknesses. So noted that Uber operates in 70 different countries, so a wide reach around the world. Again, they view themselves as a tech company, not necessarily like a logistics company or a delivery company. They see themselves as providing technology. And multiple times throughout the annual report, they talk about using technology to connect drivers, merchants, shippers with end users. So, the end user is their customer, but also their business is not necessarily DTC, so direct to consumer. They're providing the logistics to get certain people to a customer, so to speak. So looking at segments, they have 3 segments. They talk about mobility, delivery, and freight. If you go to the last column of notes, I do point out they really have minimal and kind of vague discussion throughout the annual report on that freight or transport or logistics business. It gets referred to differently throughout the report. I'd love to know more about what that involves, but I didn't feel like I got a lot of information on that. The focus of the company, these are in major bullet points early on, talking about the business. They want to focus on having a massive network. Again, 70 different countries. They want to be the go-to. They want to focus on leading in technology. Again, coming back to tech, seeing themselves in that light. They want to focus on operational excellence. This is a challenge, I think, for a company like Uber. They don't have direct control over a lot of the things that happen between drivers, merchants, shippers, and the end consumer, the end user. So that can be challenging, and we'll talk about that some more. And then also they want to have product expertise. I think this is an area they really excel at. So different concerns, and we're kind of going to be going between negatives and positives here. So I'm just laying them out as I notice them in the reports. So of course they have a big section on risk factors early on. So one of their big concerns is about platform users engaging in criminal, violent, inappropriate, or dangerous behaviors. So, you hear those scary news stories about a driver, hurting someone, or, someone gets in a car and they hurt their driver or something like that. And so I put the note there, they definitely have to work very hard to avoid what I call the hitchhiker connotation. Hitchhiking used to be a really big thing. It was super normal up and through maybe the 70s. And then people started getting hurt or going missing. And so we don't hitchhike really anymore. I still see people here on the highways where I live trying to hitchhike, but the regular average person like me and the people I know, we probably don't stop very often. Big, huge contingent liability, something they're really struggling with in a lot of areas and have made a couple losses in, is this conflict over drivers being classified as employees. Uber was the big rise of the gig economy. Well, there's a lot of people that aren't just doing it on the side anymore. It's their livelihood, and they want, they need benefits and stuff if that's going to be their career. So this is a big challenge for the company. Because, if it's just gig workers, you basically hire them 1099. I've never been a driver, so I don't know the exact nature of operating in that way. But, you're not necessarily going to get benefits. You're not necessarily going to get the full treatment of an employee of the company. And I think that's an area that they're kind of lacking. But also, from a business perspective, they have to continue to prevent that from happening. But of course, take from that what you will. In terms of competitive advantage, they had this little section of bullet points, and it really concerned me, right? They're talking about their ability to compete. This is something you want to see, that they have a strong, it's called a moat. So it's an area around them that prevents others from actually taking their market share. But in this section, they talk about they operate in a highly competitive industry. There are many other well-established and low-cost alternatives. There are significantly low barriers to entry. There's low switching costs for consumers, and there are well-capitalized competitors. So basically, everything you don't want to see when you're looking at a company's moat or its competitive advantage. You want to see it can be highly competitive, but you don't want others who are well established, or at least not low cost alternatives. You want to see high barriers to entry in an industry, and you want high switching costs. So if they use you as a vendor, or as their supplier or whatever else, as a business, you don't want them to be able to switch cheaply, or for other companies to show up and steal, your market share. And again, you also don't want your competitors to be far enough along in their business that they have access to capital. I'm going to try to keep moving quickly through this. Competing for them requires lower fares, higher compensation. Again, that's a challenge there, because that's going to affect the bottom line. There's a note in the annual report where and this is in a direct quote, "We may not achieve or maintain profitability." Not something you really want to see in a company's own words talking about themselves, but definitely something to consider. Like I said, they're in growth stage here still. They're exposed to significant media coverage. They have a lot and a strong potential for brand or reputation damage. Surely you've seen some of the stuff. I've seen all sorts of things about Uber, and so people can get a really negative impression of them and start looking for alternatives. In terms of drivers being classified as employees, there's one specific example from this end of this last year. Uber had to pay out $521 million in a settlement of a class action lawsuit. So that's just one small example. That's not even all of the other litigation that they're sorting through. And here employee classifications are cropping up, and California is really notable, also showing up in the Netherlands, the UK, and a lot of these places, and many other places as well. But they're trying to give drivers what are called taxi collective bargaining rights, which again would really challenge Uber's strength in being able to run the business. They noted here non-US markets account for 76% of all trips. Now, I definitely want to go back and reread that and just confirm that when I read that, that's what this means. But it does tell me that there is a huge market outside of the US. So when we think of Uber, we think of it as a US company, but they, like I said, they operate in 70 countries. They're all over the world. And so they're really, you have to keep a global mindset looking at a business like this. One thing that concerned me, they have $9.4 billion in aggregate principal amounts of debt. So that's concerning. But, I kind of note there in column H that most of their long-term debt matures between 2025 and 2029. So not a ticking time bomb necessarily. Most of the interest rates are reasonable. So, not like there's $1 billion due this year like some companies have. They do have a higher exposure to materially greater than anticipated tax liabilities. So countries like Australia, Saudi Arabia, UK, and others, they're finding these challenges, Uber is, in terms of either disputing certain tax charges or not having to pay them. They're typically required to go ahead and pay them before they can dispute them. So that's definitely a challenge for the business. They note that they rely on billions of net operating loss carry forwards that might expire prematurely, and that would increase their exposure to tax liabilities. So something companies will do, they'll carry these losses forward. Sometimes they'll have a really good year, really bad year, so maybe they'll kick some more of that deferred income or tax liabilities and kind of slip that in there so that it looks more steady in terms of growth. Here for Uber, they're trying to put off having to pay as much taxes every year. And so if these carry forwards expire, bam, they're hit with a huge tax bill in multiple places. That's going to hurt the bottom line. They're exposed to violations of anti-corruption laws beyond their control in countries known for high levels of corruption. That becomes a problem when you're founded and headquartered in Delaware. Then you have to comply with, these international laws that affect you as a U.S.-based company, that you have to comply in certain ways to ensure that corruption is not happening. They've got these high levels of insurance requirements. That's going to come up in audit concerns. One thing I noted here is debt instruments include restrictions on paying dividends. So quite a few of the debt instruments that they've used to finance the companies actually prevent them from offering a dividend. So I've noticed, I'm on Twitter a bit. I've noticed people talking about Uber, talking about, I see in the near term future, they're going to pay dividends. I'm sure they'll be profitable and be able to do that. Well, Uber has noted that until they get rid of these certain instruments, that's not even remotely a possibility. So something to keep an eye on. Audit concerns were fairly normal in terms of, these two issues have to do with subjective nature of management's assumptions in these areas. It was interesting, their presentation of mobility and delivery revenue agreements, including incentives, discounts, and promotions to drivers, merchants, and end users. So that was kind of interesting. There's a couple sections there on that, not just in the audit thing, but right prior to it and right after it in the notes. So definitely check that out if that's something you want to understand a little better. And then they also had to deal with the valuation of insurance reserves. I've seen this in quite a few companies, especially ones who are subject to potential insurance claims. So something to keep in mind with Uber. They also, this was concerning, their chargebacks and credit card losses have really increased over the last 3 years, went from 178 million all the way up to 268 million. These are, instances in which someone pays and then the company can't actually collect the money, or the debit card, it's an overdraft, the bank kicks it back to them. This can be expensive for a company, and they're reliant on customers' payments actually going through. So this can be concerning if that's continuing to increase through 2023 and on to the future. To note, so the principal versus agent concept, I don't want to go too much into it, but Uber's in a weird spot, right? Again, they're not direct to consumer. They don't have full control over all aspects of their business. So there's some instances in which they're the principal. In terms of litigation and stuff, they're directly responsible. Whereas there's a lot of instances in which others are in control of that on behalf of them, acting as agents. And so it can be kind of confusing, especially when they get into litigation, who's responsible, having to really flesh that out. And the better they can do that, the better they can avoid more litigation. Already mentioned maturing of long-term debts. I noted here, this is in the notes to the annual report. You're not going to find this just publicly listed somewhere, but their diluted net loss per share for common shareholders increased from 2020 to 2022, going from negative $2 all the way up to negative $4.65. So we had looked at earnings per share, and it looked like it wasn't doing too bad, but this tells me, maybe some cause for concern if they're not increasing revenue per share. Multitude of acquisitions and divestitures. I didn't want to go through listing them all again, trying to keep the videos shorter. So definitely go check that out. This can be problematic for businesses, especially if they overpay or they end up having to book a loss on the acquisition and then the divestiture. So some of these have worked out for them, but a lot of them, you've never heard the name of it. Hopefully they've been able to incorporate it into their business, but that can certainly be a challenge if a business becomes a serial acquirer and not actually just focusing on their core products. one area that I think Uber is really strong in, I think this is why a lot of people have a very strong belief and faith in the company, is when you mention ride sharing, you mention, hey, we need to get a ride from the airport. The thought that pops into your brain is, bam, Uber. Like, I don't think Lyft. I don't think, any of these other things. I think Uber. Hey, we need to book an Uber. Maybe that means you're going to look at different services, but the first thought in your mind is Uber. And I think that's a strong place, right? You think phone, you think iPhone, you think, or Apple, you think electric car, you think Tesla. If Uber can continue to build that synonymous nature to ride sharing, to delivery, to eventually, hopefully, to shipping and freight, then, that's when they start building the moat. Again, not publicly listed till 2019, so the 5-year information isn't totally relevant. Again, minimal or vague discussion on freight. Looking at their competitors, there are a lot, right? So mobility, you got Lyft, Ola, Diddy, Bolt, Yandex. And then on delivery, you've got Amazon, Deliveroo, Delivery Hero, DoorDash, GoPuff, iFood, Instacart, Just Eat Takeaway, Rappi. You have restaurants themselves, meal kit deliveries, grocery deliveries, and then traditional grocers. Those last few I wouldn't have thought of off the top of my head as competitors, right? We think DoorDash. We don't think about the fact that restaurants and grocery stores are offering more delivery options. Like in my area, we finally got Kroger delivery. I live kind of in a rural area, but they drive all the way up like an hour to get to my house to drop off food. Uber doesn't deliver to my house. Kroger does it very cheaply. So this is the kind of competition that Uber's got to work through, especially on the delivery side. On freight, of course, you see a lot of big names: C.H. Robinson, Total Quality Logistics, XPO Logistics, Convoy, Echo Global, Coyote, Transfix, DHL, and Next Trucking. A lot of these I see on the highway every day. The fact that Uber was involved in any kind of freight or shipping was something totally new to me, and probably to you as well. So that's all I have for today on Uber. If you have comments, you got questions, you got concerns, maybe I miscalculated something or got something wrong, drop it in the comments. Let me know. I love the feedback. I've gotten some great ones over the last couple videos. If you have a request, you want to see a certain company, you want to see a deep dive on them, an analysis of them, drop that in the comments as well. Of course, as always, like, comment, subscribe. You subscribing and liking these videos helps me out as a creator. And also, just trying to build the audience, trying to make these videos better. And also, it helps you as well because you don't miss out on this content. Don't miss out on kind of getting these up-to-date deep dives into companies. And as always, I just want to encourage you to, dive in, read the annual report, study these businesses, and most of all, invest well. You guys got this. I really appreciate, we're almost to 100 subscribers, so cannot overstate how thankful I am for each and every one of you. I will see you next time. So until then, this is the Value Formula. Hope you have a great day.